That, of course, President Trump, Ukrainian President Zelensky during that heated exchange earlier today in the Oval Office. Markets reacting to that uncertainty, selling off before bouncing back. In fact, we're at session highs right now. Let's get Ron Insana's reaction. He's iFi AI's CEO, CNBC contributor. It's good to see you. Welcome back.
Thank you.
Reaction as you viewed that today, but again, just through the prism about how the market should be thinking about these complex geopolitical relationships that we have and the way that some of them might be changing.
Yeah, I mean, I must say, Scott, I'm pretty much taken aback by the market reaction that we've seen, thus far, leading to new highs for the day. I think maybe what's going on here, a couple things. Interest rates are down, and so that's a cushioning factor for the equity markets, with the yield on the 10-year now at 4.21. Concerns, perhaps that the economy is weakening, as Avery was saying earlier on. I don't know how to put this particular event in historical context. I mean, I've been watching the news. My first experience was watching Lyndon Baines Johnson announce that he wasn't going to run for re-election in 1968. And I can say, honestly, I've never seen anything like the tag team in the White House that we saw today with Vice President Vance and President Trump and President Zelensky. I don't recall anything ever like this in the public eye. And so I'm not quite sure how to interpret the market's response, other than to possibly look through this and see that there's an end to the Russia-Ukraine war coming, that maybe, as Michael McFaul was suggesting, there's a mineral deal that's positive for the U.S. on the other side, and that this is coming to a conclusion in some way, shape, or form. I am struck by the fact that European markets are dramatically outperforming the U.S. I mean, we look at Germany, Italy, and Spain. They're each up 13%. We're flat on the year. So I think the markets are starting to look through a lot of this, not necessarily to our benefit, maybe to Europe's more so than that of the U.S.
But, I mean, there are those, who have had the perspective for a while, even coming into this year, as optimistic as they were about this new administration, more pro-growth, was the belief that the first half was going to be dicey anyway, because it was going to take some, sausage-making process to get to the tax cut point, and that's ugly, right? And no one likes to see that, but you were going to have, executive orders and tariffs, and that was going to be volatile in the first half of the year. But second half, you were going to start to get the fruits of the reward of what people thought was going to happen.
Yeah, I'm not sure I buy that. I mean, I'm a little more pessimistic on the outlook for the U.S. economy than I have been in for a while. I mean, when you think about the possibility of, a couple 100,000 federal workers being laid off, and of course, if they do get 8 months of severance, they won't be immediately applying for unemployment insurance benefits. But we did see jobless claims bounce yesterday. And so you could make the argument that extending the tax cuts, which don't change a lot in terms of what people's take-home pay would be, is one, going to increase the size of the deficit and the debt, and number two, it's also going to weaken the economy simultaneously as DOGE, kind of moves through the federal government and reduces employment in a noticeable way. If we were to see claims in a couple of months hit 400,000, those are recession-level numbers. That would freak the markets out, I think. And so I'm not sure how pro-growth all of this is, really. And the tariffs most certainly are not. And I think even the bond market is looking at tariffs as more of a recessionary issue than an inflationary one. Certainly that's what the behavior would tell us. So I'm not sure how pro-growth the first year of this really is, despite the conventional wisdom that has been pushing that line, since before the election.
There are obviously high hopes related to the AI trade, one in which you are now, as we said at the outset here, involved with professionally. But what did you learn, do you think? What did we as investors learn this week about that trade?
I think to a certain extent you're rotating away, and this was true during the internet era as well. You move away from the infrastructure plays, which have laid the groundwork for applied artificial intelligence uses. And I think so as you move away from infrastructure, you start looking at more applied uses, whether it's in healthcare, whether it's in financial services, legal services, and the like. I think the plays to come from a public markets perspective, to the extent that they're available, are going to be in ways in which artificial intelligence will be used to enhance either existing businesses or provide new services to companies that heretofore have not been available. So we did this from 95 to 2000, you moved away from the pick and shovel plays eventually and started going into the applied plays. So, in the early days, it was the build out and it was the laying of fiber, and then the Amazons of the world and the other successful players who were overlaid on top of that infrastructure became the more dominant themes. And I think that's probably where we are in this part of the cycle.